Hello, I'm Tony Kay. I'm the editor of Eureka Report. Welcome to today's Advisor Q&A. I'm joined today by Bruce Brammall, our financial advisors, and also InvestSmart's Head of Portfolio Services, Mitchell Snedden. Thanks for coming in, gents.
Pleasure.
Now, we're doing a bit of a rerun of last month simply because we had so much interest in it, and it's all around the changes to superannuation and pensions. So we're calling this Understanding the New Super Rules 2. So let's pretty much continue on where we left off last month. The only difference is I think we'll start off, obviously as we're getting closer to June 30, you're all hearing different things from your particular customers. And I just thought I'd start off, Bruce. What are you hearing from your clients at the moment?
Well, there's still a lot of confusion, obviously, because the rules are still to come in. But the main questions, I guess, are around the $1.6 million limits. There being sort of two limits, one being the transfer balance cap, the other one being a limit around which you can or can't contribute further to super. If you're over 1.6, obviously you can't make any further non-concessionals. You can make concessionals though. Some of them, are quite complicated, which are a client-by-client proposition, and those are the ones particularly around whether or not you take the CGT relief, and that's literally a question that can't be answered as a yes or a no. You have to sit down and work your way through your own list of investments and find out what the best solution or the best choice is to make for yourself there. And it has to be done on literally an asset by asset basis in a portfolio. Outside of that, there's sort of, do I put in my maximum non-concessional contributions? How much have I put in the past? What will I be able to do in the future? Can I put it in? Are the rules changing around at what age I can contribute? There's a lot of sort of general questions. There's a whip up of panic, obviously, and a countdown now of a little over 3 months. So the questions are starting to be snowball, I guess, and they'll become more and more constant as we move in closer to June 30.
Yeah, and as we've put up recently on the site, actually, we've only got 3 months to go, just about till June 30. So it's not quite action stations, but people do need to start doing things. Max, what are you hearing?
Most of the questions are coming about for those that are over the $1.6 million is, do I go with segregation? Do I go with the actuarial method? And from a point of view of what's the best way of switching investments, where should I be holding them and things like this. If I'm over the 1.6 million, what am I leaving in pension? What am I either taking out personally or putting into accumulation account? And that tends to be one that it's a mechanical, as Bruce says, that you're going to have to go through each of your investments if you're using the segregated method. And the beauty is, using the segregated method, you can pick whether you are using the or asking for the CGT relief. If you're in the actuarial method, you don't get a choice. Everything gets revalued in one hit, and that's going to be another question that members of super funds are going to need to ask, and be asking of their SMS of advisors, because it's not unrealistic to think that they may have been in the actuarial method previously and have made a decision on the 1st of July that they want to be segregated from then on. The interesting thing is, when a fund is totally in pension phase, it's automatically segregated. There are some people that they may be better served to be able to have the actuarial method, but if they're all in pension, they can't. So if they're able to make a contribution at some time during the year, which will force that decision to be made, it may be worthwhile, and they'd need to get their advice on that, on being able to use the actuarial method.
Right. The other thing that we know is coming up is that from July 1, the non-concessional contribution, we won't talk so much about concessional contributions at the moment, but NCCs, as they're shortened to, are going to be dropping from $180,000 a year down to $100,000. Using the 3-year pull forward rule, that means the total would drop from 540 down to 300. Quite a big drop. I just wanted to have a chat to Mitchell about that at the moment in terms of what you're seeing on the product side of things.
There's nothing quite like a deadline to spur people on into action, and what we've been seeing is a gradual increase of applications coming through specifically for our separately managed accounts, and more specifically the higher income producing products. So the product that's been getting the most amount of inflows and activity around it has definitely been our Intelligent Investor Equity Income portfolio, and we're seeing quite a number of applications come through the door. And I'm seeing a gradual build up. A lot of people trying to get in before June 30.
And what's the actual benefit of using an SMA type structure?
I guess it's one for a start, as compared to a managed fund, it's more tax efficient. Also, as well, you've got the full beneficial ownership of the underlying shares, so you actually own that portfolio, so you can see the individual stocks hold, so not just the top 10 or top 5, but everything. So if we hold 25 stocks, you see all 25, you see the units that you hold in them, you see the winners, you see the losers. So that's a big plus for people as well. But really, when it comes down to it, for a lot of people go to the income focusing portfolios. That is what they are really concentrating on, and the SMA structure gives people a lot of flexibility around that. So unlike, say, a managed fund where you have to wait for your 2 distributions a year, you can dividends as the holdings pay them go directly into a linked account of your choice, and so that's really handy, just like you're managing your own portfolio. On top of that, you can then set, say, a monthly drawdown or a quarterly drawdown or a 6 monthly drawdown, whatever suits your specific needs. And then once again, on top of that, you can then take ad hoc payments as and when you need them, or do a combination of all three. So the self-managed super funds, especially in pension mode, are really taking to the separately managed account space because of the flexibility that they provide.
I think that the other thing is that the funds management industry has for too long been able to cloak in what they're actually doing, and there are too many fund managers out there that are saying they're active managers and really they're benchmark huggers with a little bit of extra thrown in. And with a separately managed account, there's nowhere to hide. You're very transparent, and then especially within a self-managed super fund, a lot of people want to go into a self-managed super fund for that control. They can be using someone else to be able to manage that for them, but they do have a better idea of where things are going through that SMA, and they know what's being held. And I think there's a delay sometimes between when an investor knows as to what's going to be happening, because you have to be careful you can't control or affect the market, but it becomes a lot more transparent, which is what SMSF trustees really want.
Well, we were chatting off camera just before about what was in the Intelligent Investor Equity Income portfolio, and say an event like yesterday with 0.5%, if you were invested in a separately managed account, of course, you'd see that immediate impact on your portfolio. It's about a 20-minute delay in the pricing, and you could have the comfort to be able to jump in there and go, okay, these guys are quite underweight, significantly underweight banks and resources, so our portfolios didn't take quite the hit that the broader market did yesterday. The
note of caution is the other sort of jumping. Don't get too despondent. If there's a huge market crash, we don't want you jumping off windows just yet. You need to have a bit of hold true till the end.
Keep the windows closed.
Now, we'll just get into our usual Q&A now. We've got quite a few questions in the pipeline, and I do ask listeners to send in a question right now if you do have one, and we'll try and get to it in today's session. So actually, I'll direct the first one to you, Max. It's from a guest saying that my wife and I both exceed the $1.6 million cap. In terms of segregating our assets, how do we do that? Do we have to have separate bank accounts and all that type of stuff? That's the gist of the question.
It's interesting. We are at the mercy of the tax office, and believe it or not, the tax office doesn't always get it right. There was an opinion that they had going back, I don't know how many years, Bruce, 2 or 3 or 4 years. They said that if you were doing segregation, you had to have a separate bank account for an accumulation account and a separate bank account for a pension account. they finally worked out that there is such a thing called modern accounting computer systems. It takes them a little while to catch up often, and they've realised, oh no, we don't need to have two separate bank accounts, you can keep a track. So no, you can have one bank account. In fact, because of, it's one of the few times I've had to listen to the tax office, and I ended up having, in a lot of cases, two separate bank accounts because the auditors told me I should, and I don't like having too many fights with the auditors of SMSFs, that we're actually starting to look at shutting down some accounts that used to be an accumulation account, have virtually no activity. So short answer is no, only one bank account is all you need.
Right. Okay.
And that goes to the rest of the infrastructure that you need in a self-managed super fund. You don't need a second trading CommSec or E-Trade or whatever trading account. You don't need a second platform. You don't need a second one of any of those. Modern accounting software is able to look after all that for super funds.
Yeah, the ridiculous part is though, those same modern accounting platforms would enable you to say this member has 550 of the BHP shares that the super fund has, and someone else 450, they virtually say, well, if you've got 1,000 BHP shares, that has to almost be allocated to one member. Hopefully the tax office will at some time realise that these modern accounting systems will be able to cope with that, like they finally woke up to what can happen with a bank account.
I've got another question from Terry. Terry's got 1.9 million. He wants to know if he rolls 300,000 of that into an accumulation account, can he specify that 300,000 be designated towards fixed interest investments? And if so, does he also need to reset the assets on the total amount of super that he has?
From a point of view, in other words, let me understand the question, can he designate what is going to end up being allocated to whatever pot?
I would have thought so.
Oh, see, the interesting, that's what segregation's all about. Yeah. Segregation is about saying that these assets are allocated to these members who are in pension phase, and these assets are allocated to these members who are in accumulation and pension. So that's what it's all about. Picking. The only trouble is, because of the tax officer's opinion, you can't even say that, okay, 50% of a term deposit is accumulation and 50% is pension. You have to allocate whole assets to each member within each of the different types of accounts.
Yeah. So let's just talk briefly on the resetting of values around the capital gains tax aspect. We know we have a lot of questions on that. What's the purpose of doing that, and and what needs to be done?
The resetting of the values on an annual basis you're talking about, or the
CGT relief?
Yeah, the CGT relief.
CGT relief is going to be, as I was talking about earlier, it's going to be an asset by asset decision that needs to be made by super funds if they're in a position to do so. The decision will need to be made, around the time, or certainly it's before the first tax return is put in for the 2017 year. But it's literally not well, you should apply for the relief or you should not apply for the relief. Everybody's investment portfolios are going to be different, and you need to work your way through the portfolio, knowing what your cost base and knowing all the other information, what your cost base for the asset is, what it's valued at on June 30, July 1, and going through and making the decision. The other thing is that this only lasts for 10 years, so if it's an asset that you think you might hold forever, there might be a different decision process that's made in regards to that, because it's any relief that is sought will only last for 10 years until mid 2027.
Yeah, one of the things I think, and I'd be interested to get your feedback on this, that if the decision needs to be made as to do I end up claiming the CGT relief or not, allocating the assets, segregating the assets, in segregating them because they have the option of choosing it or not, what you'd be wanting to do therefore, if you had an asset that at that point in time was already at a capital loss situation, my feeling would be is you'd allocate that across to the accumulation account, not claim CGT relief, and have the assets so therefore that ends up being in the accumulation account, where at some point in time in the future, when you may have capital gains coming through, you can end up then, having a capital loss that you're going to be able to offset against it.
Yep.
Because if you choose to do it in this year it ends up staying, is my understanding. So, from that point of view, you probably, you'll lose the benefit because you're doing it back at market. If you've got something you bought at $20 and it's now 10, if you choose the CGT relief, it goes down to the 10 and the loss is lost. Whereas if you choose not to the CGT relief and it goes in at the $20 cost, you're building in a bit of a carried forward capital loss situation that you can, in your accumulation account, offset against future capital profits.
And you'll also get some of them wrong. But people are bound to have the $20 that's fallen to 15, apply one or the other, it goes to 25, it falls to 10, and whatever the choice they made when the time comes to sell the asset in 6 months, 2 years, 5 years, they're going to have got it wrong. But the ATO is saying you've got to make a decision, and you can't have the best of all worlds. You have to make a choice.
Yeah.
Okay. Yeah, complex question in a way that it's really case by case, isn't it?
Exactly.
Case by investor by investor and asset by asset.
It's where people need good information to make their decisions in relation to what they're buying and what they're selling.
Definitely. Now, I've got another question from James, and this is also along the lines of one that keeps coming up. James has got a $1.2 million property. He's 64, turning 65, planning to retire this year. He's also got another $600,000 in his account. Now, he wants to know, in terms of the cap, does he need to take $200,000 out when he retires, or it's all around this $1.6 million cap question.
The answer is, and go back and have a look at one of the columns that I wrote, we were talking about it a little bit earlier as well, is around this three pots strategy, or what I'd call the three pot strategy, which is your first pot is your 1.6 million in super, that you're putting into pension. The pension fund pays no tax if you're over 65 or have met the condition of release, pays no tax, and you don't pay any tax on the income. That's perfect. Then the second pot is actually not necessarily an accumulation, but outside of super, because you have the $18,200 tax-free threshold, which with SAPTO and the like rises to about $28,000 or $29,000 a year in income. So you can have an amount of money outside of super in your personal name that is earning income, and so long as you stay under that threshold, then you're not going to pay any tax on that. How much is that amount of money? Well, it actually depends on the amount of income that you're going to earn. If you have a $500,000 investment, $500,000 worth of investments, and they're earning 5%, then there's $25,000. If that's the only income that you earn, then that $25,000 is going to be tax-free as well. The third pot, if you're exceeding both of those, so you've got your 1.6 and you've got enough to be earning up to the tax-free limit outside of super, then probably pot number 3 is back in accumulation, where you know that the maximum tax rate you're going to pay is 15%. So you've got 1.6 and you've got your $500,000 or $1 million outside earning up to that threshold, and you've got excess money outside of that, then sitting back in the accumulation account might be the next best option for you, if where you know you're only going to pay 15%. So 3 pots strategy, and the first 2 pots managed properly, you won't pay any tax at all. In this instance, we don't quite know. We've got 1.2 million property, 600,000 in cash, taking to 1.8. Depending on what you've got outside, it might actually make sense to bring the $200,000 outside of the superannuation system into your personal name, where you can, whatever you're earning, 3% on cash or 4 or 5% in dividends. If that's keeping you under the tax-free threshold, then you're not going to pay any tax on that money anyway.
Yeah, the short answer in the end, though, is you don't have to do anything precipitately. That because, and most people have agreed that as long as the trustees of the super fund or the members of the super fund have ended up effectively instructing themselves as the trustees, that at the 30th of June 2017, once my members' balance in my pension account has been finalised, any excess over the 1.6 million pension cap I would like to be transferred across to the accumulation account. Is that then once that happens, if they want to take it out from there, they do it. Whether it's, I don't think it's going to be worthwhile artificially taking money back out by having a commutation so that you've got less than the 1.6. People should more concentrate on looking at the situation as that whatever I'm allocating into the 1.6 pension account will be those assets that I have the greatest expectation of increasing in value, and what I'm putting across into the accumulation account aren't necessarily that, because I can pay no tax on the assets that are in the pension account. I've got a possible tax I'm going to be paying on the accumulation, even if it's only 10%, or if I'm getting it out. So again, nothing needs to be done hastily, and especially nothing should be done without getting the advice.
Okay. Got a question here from Alan. Alan's got about $2 million. He's 68, so he's in pension mode. He knows he's going to have to roll back some money into accumulation. Do the minimum drawdown amounts apply to the total, both accounts, or just to the pension account?
Just to the pension. If the decision is put the $400,000 in excess back into accumulation, then regular accumulation rules apply to that amount. The sort of the real change is that you will be able to draw from that accumulation account if you want to. But there's only going to be $1.6 million in pension, and the legal requirement is for the pension to be paid out on that. So up to age 65, that's 4%. 65 to 70, it's 5%. So 5% of the 1.6 million is all that will be required to be pulled out of super.
So you can basically
out of the pension account. Sorry.
You can basically put money into your accumulation account, and it can just sit there and.
Well, no, because the strategy should be, because the money in superannuation pension accounts are so powerful, and if it wasn't so powerful, they wouldn't be putting the 1.6 million limit on it. The strategy should be is that you should only take the minimum pension, with the money that's gone into accumulation. For you to be in this situation, you must have met a condition of release. So it's your money now, and you can take it when you want to. You don't have the normal restrictions if you haven't met a condition of release of getting it out. So you end up with your 1.6 million in the pension account. You've got the rest of it in accumulation, and you take the minimum out of the pension account. And if you need a top up, you take them as lump sum tax-free payments from your accumulation account. Because what you don't want to do is increase the pension payments on your pension account, which means it's decreasing, because pension payments do not have an effect on the 1.6 million limit. The only thing that has really an effect on that is commutations. So you don't want to run down that valuable pension account asset. If you're going to be taking anything out, it should be done as tax-free lump sum payments from accumulation.
Yeah. So in other words, you take out what you have to from your pension account, and then top up out of accumulation as you need it. Yep. Good strategy. Another question from Alex. I'm going to have to put my glasses on, gents, because my eyesight's fading. But and I'll bring this over here just so I can read it perfectly. Well, how often will the $1.6 million cap be assessed? Is it each year, or is it a one-off?
It's a one-off at the time that you start the pension, or 1 July. This is another one of those very common questions. What happens if I grow my pension fund from 1.6 to 1.7 or 1.8? Do I have to take 100,000 or 200,000 out of it the following year? The answer is no. The 1.6 million is your starting for your transfer balance cap. If you draw the minimum pension out of it an amount for 32,000, depending on what your age is, for 64,000 if you draw your minimum pension out of that, but you manage to have a great year for investing, and you actually manage to grow it by $200,000 or $300,000, so that you've got 1.8 or 1.9 in there, that's fine. It never has to be reset. Your pension fund can grow as much as it can if you happen to pick, make some wonderful choices. You could end up with a pension fund that started at 1.6, and then even though you're drawing pension income streams from it, they could go to $2.5, $3 million. It's possible. It only has to be done once. It's not reset and pull out money every year. Really good investors will be able to, or lucky investors, or whatever you want to call them, will be able to grow the pension fund despite the fact that they're having to draw money from it each year.
And the only change to that will be is for some of the strategies that are out there that the limit is instigated effectively at the time, either anyone who's in pension phase at the 1st of July and anyone who goes into pension phase after that, that the only time that can be reset is effectively with a commutation.
Yep.
Or if someone's below the 1.6 limit now, they transfer more money to pension. So the original setting is at that point, but there is a situation where I know there's a strategy for recontribution for reclassifying taxable to tax-free. Someone at the 1.6 million limit, as long as they have the ability to make further contributions, can still use that strategy by doing a commutation and then putting it back in. But there are some strict rules that need to be adhered to, and again, advice needs to be got.
Yeah. The other thing with the one, we're talking about 1.6, but the government said that over time that limit will be lifted.
Yeah, well, that's a CPI. It's CPI thing. It's going to be lifted in $100,000 increments. So,
yep.
In the background, it'll be increasing from 1.6 to 1.62 to 1.6, whatever. It might be 5 years or 6 or 7 years or so, depending on CPI, as to when it will be lifted. But it will be lifted as CPI would have taken it to another 100,000.
Yeah.
So it might be 5, 6, 7 years, the 1.6 will go to 1.7.
1% inflation rate, because we've been pretty low, that's 16,000 a year. It's going to take a while to get to the 100,000. Maybe we need to pray for 5% inflation. I don't know. No, okay. So it's just a thought.
No, we'll stay away from that one too, Max. This is, it's not necessarily related to the changes, but Michael wants to know if a capital gain is realised, does the 45-day rule apply in terms of buying back? I presume this relates to shares primarily, repurchasing the same asset.
I had a look at that question. I wasn't quite sure where they were coming from.
That to me, I'm not 100% sure. I do know if you choose to use the capital gains tax relief, you have to be very careful, because if you do that, the 1 year time period starts from then. So for someone who is looking at using the capital gains tax relief, they could be disadvantaged if they have a share that they know that they are going to want to sell between, say, January 2018 and June 2018. They would want to choose a date so that when they did that, and that was one of the assets going across to accumulation, you'd want to be doing that revaluation so that you'd use up your 12 months and get that 1/3 discount. But from the 45-day one, I must admit, I haven't had too many worries in my whole professional life of people falling foul of that, but I'm not sure. I don't know whether I've seen much on it.
The question was coming in regards to wash sale.
Yeah, I think if that is, but I don't know from the wash sale, I've seen nothing on it to give me a better understanding of what with the interaction with this stuff, whether that would, the only time I've seen there's been a situation where they're saying if you choose the CGT relief and effectively have a sale and purchase on the 1 day, relates to the resetting of the 12-month limit. Haven't seen anything in relation to the 45-day.
Right. Yeah, I wasn't sure whether the question was talking about the.
I thought it may be to do with the wash sale.
Yeah, that's what I'm
wash
saying.
Sale. If it's sort of under the wash sale rules, the ATO doesn't want people selling an asset and repurchasing an asset simply to improve their tax position. So there are not so much ways around it, but there are strategies by which the ATO will accept, well, you haven't done this just for tax, and that might be selling 1,000 BHP shares, but making the decision, well, I want the equivalent amount of that, but I want it in Rio because I believe in Rio's assets are going to work better over the next, or selling CBA for Westpac or something like that. You've changed assets, which is a completely different thing. A wash sale is when you sell your 1,000 CSL shares because you happen to buy them a little bit higher than they were now, and you're creating a loss. from 120 to 120 bucks a share to $100 a share or something like that, and you're locking in that loss of $20 a share, then immediately repurchasing them here. So if you're doing that, then the same number of shares or similar number of shares, the ATO is going to say, hang on, you're just trying to create a capital loss there for a tax position, and we're not going to accept that. So if I wasn't quite sure.
Well, the other one is the imputation credit type thing.
And it's 45 days around.
You've got to hold it. You've got to hold the share for at least 45 days to be able to claim the imputation credit. So you can't have someone who's buying a share for the dividend and sells it in under 45 days. If they do that, they don't get the imputation credit, isn't it? Is that the...
There is, but I don't think that applies so much for retail investors as it does for larger funds.
It would apply more to retail than I think I don't know. But from that point of view, it's one of those areas where I haven't had to worry too much about, and if I don't have to worry about it, I don't look at it under the microscope. Maybe it's something, if the question comes through for the column, I'll have to.
Well, Michael, I suggest you seek some personal advice on that one, because it probably relates to your situation. Let's move on. We've got quite a few questions coming in, actually, to get through. Quick one from Merv. Merv's got 1.6 million. Is there a period of, or he's got more than 1.6? Is there a period of grace in terms of moving money above 1.6 into accumulation? We know that the tax office is going to be fairly strict on this. And is there sort of like a margin that the ATO's put in place?
There doesn't need to be any grace period, because there's enough flexibility built into the system whereby, as long as you have the documentation in place, which means that at the 30th of June, anything that's over the 1.6 million gets switched to accumulation, you deal with it then. The only where there is a period of grace is that the tax office is saying, if you haven't got it right, if you haven't put in that documentation, and any administrator of an SMSF that doesn't have that documentation in place, you'd need to seriously look at your administrator if they haven't put that in place, is that where the excess is under $100,000, the SMSF still has the ability to access the CGT relief. If it's more than 100,000, they don't get it. So that's the only area, but it's something I don't think you have to worry about, because if you've got the documentation in place, you won't have a problem.
Now, if you're listening in today and you have asked a question and we don't get to it, we will aim to get your questions answered. Max and Bruce are on the case, and they write regular columns for Eureka Report, so we might have to do it that way, but otherwise we'll try and get to it today. Next question is from Charlie. Charlie's in a transition to retirement pension. When he turns 65, when he turns 65, does it automatically move to an account-based pension, or does something need to be done?
No, it becomes an account-based pension.
No, he doesn't have to. Just because he turns 65, he has met a condition, the ultimate condition of release.
Yeah.
But he would need to be getting strong advice to be keeping his super fund in accumulation, because if he keeps it in accumulation, he's paying the 15% income on 15% tax on income, whereas if he put it across the 1.6, if he's got $2 million in his fund, it still makes sense to start a pension as soon as he turns 65 on the 1.6, because at least he's going to end up not paying the tax. So
I think the question though was, Tony, was he's on a TTR already, so he's already in pension, but on a TTR.
It's a no-brainer. He's got to switch it to. He doesn't have to, but if he didn't switch it from a TTR, because it's a documentation thing, the TTR is going to be paying tax at 15%. It's going to be taxed like a normal accumulation account. So again, it's a no-brainer. You just do it.
Yeah, makes perfect sense. Even if you're still working, I suppose you just do it. This is a question from a member. It's a bit of a complex one, so I'll put the specs on again. If a member has 1.8 million in pension phase and 500,000 in accumulation, is it better to start a second pension with the accumulation balance now, so that the actuary percentage at June 30 this year is higher for the CGT cost-based election on 30th of June 2017, assuming the market value is higher than cost at that time? Does that make sense?
It does to some extent, but it really goes back to the CGT relief side of things. And I mentioned it before. he has a fund that the trustees, because there was an accumulation account of 500 and the pension account of, I forgot what it is, that the trustees have the choice of either using the actuarial method or the segregation method. If it was all in pension phase, it's automatically segregated. I think there's the flexibility. I don't know whether he would end up with any benefit of having the 500,000 and therefore him have a pension account of the 2.1 or whatever, everything adds together to 2.3. Again, this is where advice is going to be important. It has to be done on a case-by-case basis, that if he's got some dogs in the accumulation account at the present, that are going to have a great increase in value later, I mean, even then, he doesn't need to do much other than make sure he uses the segregation method, and those are the shares that will go across. It's very hard in these cases to give broad advice. It's a real case-by-case, investment-by-investment decision.
Michael has a question in relation to determining the $1.6 million cap. How is a Commonwealth Government defined benefit scheme worked into that equation?
Yeah, so the CSS and PSS pensions predominantly defined benefit pensions. What happens is the amount is multiplied, whatever your annual pension is multiplied by 16, and that is the essential use. That's effectively the use of your transfer balance cap. So, if you're receiving a defined benefit government pension of $100,000, you multiply that by 16, you've got 1.6 million. That's going to be counted first, and you've basically used up your entire transfer balance cap. If you then have a self-managed super fund or a retail fund or something like that, then that money is where you're going to have to come back and it's going to need to become accumulation or taken outside of the system. So the reason that was done is there's no way of changing a defined benefit fund. You can't do anything with it. So that sits on the pecking order. That's going to sit number one, multiplied by 16 or whatever the amount is at June 30, and that will be what the figure that's multiplied by 16 will become part of your transfer balance cap.
Okay. And there was a similar question from Noel around the Commonwealth Super Fund, how that's treated. Yeah. That'd fall under the same thing.
Yeah. And then it comes down to whether it's the sums are being taxed or not taxed. And that'll come down again to individual positions and what the source of the DB funds are.
The interesting thing, people will be in the dilemma of if they've got their lifetime pension, and if you're under 100,000 a year on your lifetime pension, well, you haven't automatically blown out of the water with the 1.6. But what you need to be taking into account, if you've got a pension of 50,000 a year, 800,000 value, and you've already got 1.6 in a pension account in an SMSF, you're going to have to then have, you can't end up stopping the 800,000. So you're going to have then have this situation with your SMSF of saying, well, I'm going to have to then have the 800,000 either come out. In fact, you wouldn't, because if it's a lifetime pension, it'd be taxable income normally if it's an untaxed fund. So in that case, if there was sort of like a golden rule, if you are getting an untaxed taxable pension, that you get some of those rebates from a lifetime pension, and that's obviously on top, they're giving you a taxable income, you would be best to then, in that situation, the excess should go across into accumulation and stay there, because you're only going to be paying 15% tax. So that's where the complication will be with some people, because they don't have a choice of stopping the lifetime pension. They're going to have to take the corrective action in their SMSF.
Correct. Yeah.
Just skipping down a couple of questions, we'll come back to others, but Bruce, you recently wrote an article about partial commutations. There's a question around that as to what the benefit of doing that actually is.
Yeah, I got an email in the last day or two which was identical. I assume it's come from the same person. So, and the question is, do you take partial commutations? Why wouldn't you just take money out of your pension? Out of your super account? And the answer is, well, if it can make sense to take it as a commutation, it can also make sense to take it as from your super accounts. But you need to look at it for an individual basis. I can't remember the exact example I used in that column, but you might not be able to access, for example, some people might not be able to access their super fund to pull funds from very easily. But also for others, I guess importantly, who don't have money in an accumulation account, making use of partial commutations to reduce your super balance, to reduce your pension fund balance, will become important for the, in the possibility that they can make extra contributions to super later in life, an inheritance, sale of an investment property, where you can get some of the money to super. If you have taken those partial commutations and brought it down from 1.6 to 1.3, 1.2, then you have the possibility of being able to increase or add to your pension fund, resetting it at the 1.6.
From the partial commutations can be powerful for in cases where it's the partial commutations that are the only things that will get you below the 1.6. So if there's a reason to be wanting to get below that, it definitely can be valuable. But again, case by case, depends on a whole lot of tax facts and superannuation facts and investment facts that in the end it's hard to say definitely partial commutations or not. It's a case-by-case situation.
Yeah, and so much of this comes down to tax planning, what you have inside super or inside your pension, what you have outside your pension. It really does vary case by case.
And it's not only tax planning, it's estate planning. I know one of the things that I'm picking up and letting clients know, and it's you don't get a bunch of roses by reminding them of their mortality. At some point, especially where super funds are made up of taxable and tax-free super, when one of a member of a couple goes, and it's exactly the same situation, because if you have two pensioners, both that have got their 1.6 million limit, and one of them goes, there are some decisions that need to be made as to which pension is stopped and the other one goes to accumulation. And on what my understanding is in that case, the death benefit pension, if that's going to be better to be kept in, you don't really have a choice, because if someone dies, let me go back a bit. When you're over the 1.6 million limit, you've got a choice of switching it across into an accumulation account or taking it out. In the event of there being two $1.6 million pension accounts, one member dies, the remaining member of the couple can only really have, if they want to keep the money in the super fund, they have to take the 1.6 million death benefit pension of their partner who's died, and the 1.6 of their pension has to go to accumulation, because under super rules, a death benefit can only be paid as a lifetime pension or as a lump sum payment out.
Right.
So that's a very important thing people need to understand as to these situations, and it's going to happen more and more, obviously, with clients that are in this situation of having the 1.6 and two people at that level, that they're going to have to make sure that they get the right advice well in advance.
I was just reading the last sort of couple of days, Tony, in regards to that. The reversionary pension, which is what Max is talking about there, it needs to be, well, there's some debate going on, but it looks like you need to be reasonably clear cut that there is no option via the trust fund rules and the pension reversionary pension itself, that this will be paid as a reversionary pension. If the ATO sees that there is a possibility that there is an option for the trustees to pay this out as a death benefit lump sum or as a reversionary pension, then there's going to be some implications, potential implications around that. So it's something that people are going to have to look at in their trust deeds and make sure that if you do want to keep it in the system, this, as Max was doing, this person's died and the 1.6 million needs to go, you need to have it clear cut that it will become a reversionary pension, and then this moves out of a pension fund into accumulation. But there's going to be some pretty tight rules around that, and I don't think we actually know all the rules yet. The tax office is still coming out with explanatory EMs, explanatory memoranda in regards to this. So we can claim to be experts, but the ATO hasn't even made up its mind on so many things.
The only thing I'm not sure about is, and we won't know until they bring out these things or their test cases, is that my understanding is that in the event of the death of the member, the trustee or trustees do have the decision whether you've got a reversionary pension or not. Once a member dies, the trustees have the discretion to either pay it as a lump sum out or a death benefit pension. So in my understanding, and I could be wrong from the law point of view, is if it's not reversionary, you are not necessarily locked out of having that pension paid as a death benefit pension. So that would keep that in the pension. So that's another area which needs to be looked at a bit closer.
Yeah, and
again, it comes back to the trustee too.
I'll dob you in, but we should have a column on that. I think keep that in mind.
Certainly.
I don't have a choice in what I write about. I only can respond, so I'd love to.
I'll throw that one open to the room. Now, got a question from Viv. Viv and her partner are both 65. They've got a $540,000 in an SMSF. They're expecting to receive an inheritance of about $600,000. What's the best way of treating that inheritance in terms of putting that into the fund? Should it be, I'm just reading the question as we go, but in terms of potentially losing some of the age pension they're receiving as well, part age pension, what's the best way of sort of treating that?
Well, they're going to lose the pension. If they're getting an inheritance, it becomes an asset, and whether they've got it inside or outside of superannuation doesn't really matter. But the problem for them is, if it's $600,000 and they're going to be getting it after June 30, they're not going to have too many problems from a point of view of their $600,000 perfect, because that's going to be the maximum as long as they haven't exceeded their non-concessional limits previously. They're going to be able to get it into super.
I think they were 65 though, Tony.
That's where I was going to head for. But if they're 65 now, and or if they're 65 now, and they've hopefully passed the work test in this year, they have until the 30th of June to get the money into super, which could mean maybe, I don't know, there are a number of strategies. If they know the inheritance is coming through in August, they may be able to go to their friendly banker, which I know is an oxymoron, but you can go and end up borrowing the $600,000, get it into super, and then that gets paid out by the estate. But they definitely, if there are any people that need to get some very good advice, that is something they need to be getting.
And quickly too, because that sort of strategy, I mean, it doesn't make sense in some cases to borrow money to put it into super, borrowing your personal name to put it into super, because you don't get a tax deduction on the borrowings that you do. But if there's a short-term reason for doing it like that, we know that the inheritance is coming in August. We want to get the money in under the current rules. We were 64 on July 1, 2016, we're able to contribute this year, or we've met the work test, or whatever the situation is, then potentially, borrowing to get the money into super, knowing that you're going to be able to repay the loan by the end of the calendar year or something, could make some sense. If they're both 65, they can't do that from July 1. They'll have been 65 on July 1. They need to be able to, in order to get money into super that's not compulsory concessional contributions, they'll need to meet a work test for next year, if that's when they're receiving it, in order to be able to get any money in. And then because they're 65, they'll only be able to put in $100,000 each. You can't use the pull forward once you turn 65.
That's it. So that's the 100,000. So it's a very critical time. Anyone who's 65 now, or turning 65 before the 30th of June, it's a critical time because of the rule changes to be getting good advice, especially in these situations where there are maybe an asset that they've been holding on to that they thought they'd keep and maybe sell it eventually and get it into super. Well, they're going to be running out of options soon.
Yeah, that's right, especially if it's a large value asset. Here's a question from a guest. My wife's 76, I'm 71. At the moment, our super fund is just in my name. Can I get add my wife as a member so we can enjoy the $3.2 million together?
No.
No.
Well, the answer is pretty much no. At age 71, the only way you can put money into super is via compulsory SG contributions, or if you meet a work test. And it doesn't sound like, unless the 71-year-old, which I think was the wife, is going to meet the work test, then the money can't be contributed in. You can't. The husband, 76-year-old husband in this case, has a balance of whatever he has, $3 million or something like that. 3.2. By adding a second person, you don't get to split it. That is his account balance of 3.2 million. You can't just split an account balance across people. It's not the way super works. That's his account balance. The only way that can be done would be to be pulled out of superannuation, pulled out and then contributed back into her account under her name, but there's going to be a problem there because of being over 65 and probably not meeting the work test. Even if she does meet the work test, it can only be $100,000 non-concessional contribution for each year. There's no pull forward, and she would have to meet the work test every year in order to be able to put in that 100,000 NCC.
Yeah. And it goes back to basic accounting from a point of view of a member's account is a member's account. By having a new member come in, when they come in, their member's account is zero.
Yeah.
The only way you can have money go into that is by being able to make contributions. And if you've got a 71-year-old and they're not working, you can't do that. But it does really, one of the interesting things about this 1.6 million limit that's come in, people who are younger might be saying, good, it's not my problem, it's all of these older people that have got all of this wealth and I don't have to worry about it. Well, there are a number of strategies that used to be used, and one of them is the spouse splitting. Because if you have a husband who's got a fairly high superannuation level now, and the wife has very little, or wife has a lot, husband doesn't, if they do nothing and the compulsory super contributions are going in, they're going to exceed the 1.6. So it goes back to the importance of this planning for the long-term superannuation future and retirement planning that you need to do, especially for some people on larger incomes, that they can avoid being put in this situation, and rather than suddenly waking up one morning and saying, oh, I'm retired and I've got 2 million in super and my wife's got nothing or my husband's got nothing. Well, if you'd done something 10 years ago, you might not be in that situation.
We are literally talking to 30 and 40-year-olds about this now, people in their 30s, where they're saying, well, you know, this is what's likely to happen. Again, husband or wife has a larger super balance than the partner, and it looks like that this person's likely to earn more. We're talking to them now about spouse splitting, about when you're making contributions, getting it into this account, into the lower account. And the reason being is that you just don't want to get to this situation where one partner has $3 million and the other person has zero. There are people who are going to be caught by that and not being able to recontribute and get the money out. But the message has to go back to couples in their 30s now, and certainly in their 40s, and it's not too late in your 50s, that you need to be putting thought into getting the assets, the super fund balances fairly close to even throughout the working life. There may be some people out there who don't want to do that for the possibility that the marriage is, or the relationship is rocky, and the fact is that for the last 10 or 15 years, superannuation has been a divisible asset in relationship breakdowns. So it doesn't matter if you've got 2 million and this person's got none, this person's going to get access to the 2 million in superannuation under whatever split up is devised. It is really important for people to start doing this, and not too late in their 50s, but should be planning for it throughout their working life, particularly starting in their 30s as couples.
Good advice, very good advice. Pardon me, I've got this bug which I can't shake, but we'll move on. John has got a couple of questions. One's in relation to the CGT arrangements. Can the cost base be reset to some shares of a particular holding and not others? So, for instance, where a company's done a share placement price over time.
This is where it's getting back to segregation. My understanding with segregation, and as I said, the ATO has only just caught up with the fact that you don't need to have a separate bank account for accumulation and pension. My understanding is that the tax office has an opinion that you cannot end up like with a property. A property either has to be all in pension phase or all in accumulation phase. You cannot split that. The same thing goes with shares. If you've got certain shares in a company, unless you've changed them somehow to split them into two holdings, the shares are the shares. and their cost base is their cost base, and if you're going to end up claiming the GST exemption on that, well, it applies across all of them. That's my understanding.
I haven't read anything in regards to. The question hadn't popped across my mind, to be honest, but it is one to.
It's more going back to just the basics of segregation and what the ATO says you can and can't do. I could be wrong, but my understanding is that where you have an asset, the asset has to be allocated to a member in pension phase. It cannot be allocated and split and say, right, 500 of this year relates to accumulation, 500. You should be able to, because there are modern accounting systems that will account for that, but my understanding is the tax office doesn't allow it.
Just another one from John. What's the timing for hiving off the excess above $1.6 million into accumulation? Is it before June 30 or at June 30?
Well, this is the thing. Again, I go back to rule number one should be every super fund, SMS super fund, should have in place documentation where that happens automatically. And because if you're over, you're over. You don't want to be over, especially by more than 100,000, or you won't get the GST. So every super fund should just automatically have the documentation in place that any excess over the 1.6 million is transferred to an accumulation account for that member. End of story. And that takes it doesn't need to be much worried about.
Now we're rapidly running out of time, so I've just got time for one more. Then I just wanted to have a brief mention about some of the things Mitchell's doing at the moment in relation to our SMA presentations. So just one last one from Peter. How does the pension cap... I'm struggling here. How does the pension cap actually work in practice? If you're over 1.6 mil, do we keep the investments exactly where they are, but just sort of separate them into accumulation and pension phase? So you following me there?
Practically, yeah. One of the other rules that have come in, as soon as a fund, an SMSF, has more than $1.6 million, it can no longer use the segregated asset method. Once a fund has more than 1.6 million in it, it must use the actuarial method. So the defining situation is as soon as a fund goes into pension phase, and the interesting thing is, for those people that aren't in pension phase and may not be for another 15 or 20 years, when they get to retirement, if they've got more than 1.6 million, then they can only transfer into pension phase what that limit allows them, and that fund will automatically have to account using the actuarial method to be able to assess what part of the income is tax-free and what is taxable. So in the end, there's no choice there. That's what happens.
Okay, thanks. Thanks very much, panel, for joining us today. I just wanted to leave us with one last thing, and that is Mitchell Snedden, who was talking earlier about our SMA products. He's travelling to Adelaide and Perth next week, but he's been doing presentations with investors in all capital cities. I do recommend that you check our website events page and book into one of his sessions if you haven't already, just to hear Mitchell explain the advantages of using SMA products, especially in retirement phase.
And we do, during the presentation, Tony, go through all the differences between, exchange-traded funds, managed funds, listed investment companies, SMAs. So we go through the entire gamut, I guess, of investment products and what's going to suit certain people, depending on what phase they're in. So.
Giving people the information to make an informed decision.
Correct.
So thanks very much, listeners, for joining us today. We will try and answer your questions if we didn't get to them today.
Hopefully you'll be with us.
I'm struggling here, as you can see.
Yes.
I'm Tony Calm, the editor of Eureka Report. I was joined today by Bruce Brammall, Max Newnham and Mitchell Snedden. Thanks for joining us again.